the $1 Million Mortgage Experience podcast.
All right, welcome to today's podcast. Today, our guest is Jon Lloyd. He is the president and co-founder of Fidelis Private Fund. It's a direct portfolio lender specializing in commercial and residential investment real estate loans in California. Fidelis offers investors the opportunity to invest in a pool of real estate secured loans, generating a competitive rate of return with a moderate risk and reasonable liquidity. Welcome to the show, Jon.
Thanks for having me.
Yeah, great to have you here. I know a little bit about Fidelis, but I'd love for our listeners to know more. So tell us about the private fund and how it started and all that good stuff.
Well, just a little background on myself. I started in banking, spent about 12 years in commercial real estate lending. So I got a good handle on, how to underwrite, how to generate loans. And from there, I got into private lending. Probably it's been about 20 years ago, almost. So I ran a fund for 12 years prior to Fidelis, a mortgage fund similar to Fidelis, where we made short-term bridge commercial real estate loans, which we went through the Great Recession, no losses, no investor lost any capital.
That's great.
So it was very successful, and then wanted to get out on my own and start my own fund. And luckily, I came across some great partners. Jon Maddux, Chad Rule, who own FundLoans, are our co-founders with me. We started in 2019. And we've just been growing ever since.
How big is the fund now?
We're currently at 50 million, have 110 limited partners, and we're growing, just looking for capital. There's a lot of good lending opportunities out there, so we need capital to take advantage of that and also just service our clients, keeping them happy. And
so we're in a really interesting time right now with First Republic Bank going down, and Signature. All these big banks or mid-sized banks are going out of business, and people are losing all their money. I mean, not the depositors, but let's say like the stock is going to zero. And people are kind of nervous where to put their capital. Like, how is Fidelis different than other banks and funds and things like that? And tell us about how it's backed and secure.
Well, it's interesting. The banks, it's an interesting business model because the depositors can get their deposits on demand.
Right.
Yet, they loan the money out. So it's not all there. So it's sort of a business model that I don't see how it can really work, because every bank you have a run on a bank, they could all go out of business.
Sure.
Where a fund like Fidelis, we protect our limited partners, where a bank doesn't really protect its shareholders, because they have a run on the bank. If they have a run, they have to liquidate, and all the stockholders may lose their money. Where Fidelis, we can slowly, allow the money to go out as we get the money in. So we protect the integrity of the partnership by not allowing redemptions if we don't have them. Yeah. As loans, we have a short-term fund, so as these loans pay off, we could roll it out. So I think it's just matching. That the short-term loans are short within a year, and so as loans roll over, we could eventually get all our redemptions, but we can't give everybody's money back because we don't have it. It's lent out,
right?
Just like a bank,
right. And so it's different than a stock. Obviously, it's backed by real estate, and we talked earlier about that. It's backed by commercial and residential real estate, correct? So it's like sometimes mixed use, or maybe it's a bridge loan or construction loan, things like that. But talk about how. I know there's a loan loss reserve. Talk about that, and maybe talk also about how being backed and the LTVs low would keep someone from ever losing their money. That's how you've kept like a really good reputation in the business and never losing money, right? I mean, because they're backed by good loans, good real estate, good assets, right?
Yeah. So just to sort of retract a little bit and start, we're a limited partnership, a mortgage fund.
Yep.
And so we raise capital through limited partners. We take that capital, we loan it out, short-term loans secured by hard assets, real estate investment properties, mainly in San Diego County. We do go outside, but primarily it's more risky to go outside, and just because we know what's in our backyard,
you can go
we feel comfortable.
Drive by the property.
Yeah, so we really feel good about staying local. and our mission is to help people achieve their financial goals. And that's, through funding a portfolio of diversified real estate loans that are secured by hard assets. And, with the intent to accredited investors, that's another point. We take only accredited investors, but who want to preserve their capital. They want consistent, predictable returns, competitive returns, and they want fixed income or compound for growth. So it's that's sort of who we are in a nutshell. Currently we're at 50 million in capital. We have 110 plus limited partners and growing, and we're generating 8% plus return, which we generated from inception, and it's closer to 9 now with rates going up. But it's very competitive. Southern California is the most competitive market in the country for returns. I mean, there's returns elsewhere higher in the country, but we believe there's more risk to doing those loans outside Southern California, just because, especially San Diego, where the market is and where we're located. Yeah,
our values, just keep ratcheting up, right? Like, I mean, San Diego has a lot of people moving here, a lot of people coming down from LA, from San Francisco, and just San Diego's a beautiful place.
Yeah. So, I mean, I just think you can't beat San Diego as far as the location, and that way a lot of people are here. The supply and demand, right? And rates are a little lower, more competitive. So, but we believe we have a fund that is competitive in the return. They're secured by hard real estate assets that. And just to talk a little bit about the portfolio, loan to values average 60% or less on average for the whole portfolio. So that it's a fairly conservative loan to value. And they're all properties that are mostly improved. We don't do land development. We don't do, it's all sort of infill type smaller properties. Our typical loan is like 100,000 to 2 million. So it's a smaller niche property that's easily sold. It's not, these big properties or big developments. So I think it's a good market to be in.
That's great. Tell us what differentiates, like, say, Fidelis from, say, another private or hard money lender.
Yeah, I think for a fund to be a really good fund, you have to have a good manager and a management team. And I think we have. Myself, I have over 30 years experience in lending, banking experience, private lending, running a fund like Fidelis. And then my general partners have experience in the mortgage industry. And so I think that management team is crucial. And I believe that does differentiate us, along with just the diversification of our portfolio. We have over 100 loans, well diversified. And as far as product type as well, we're diversified. And then one thing that is unique about Fidelis is we have a loan loss reserve, and that most funds don't have it. Banks are required to have a loan loss reserve, but it's another layer of security for our investors. And I believe that's a benefit that a lot of people don't see initially on the competitive returns. That in that return is a loan loss reserve that is another protection for our investors.
So go into that a little deeper. So if someone stops making a payment, or how does that work? How does a loan loss reserve get used?
So yeah, if we had to foreclose on a property and the loan was $1 million, we ended up selling it for $900,000, there would be a shortfall of $100,000. That normally would come out of pro rata share of the capital or income, where we tap the reserve where there's no loss of capital, no loss of income. And currently we have over 2% of total assets in a reserve.
That's great.
And so I think it's something that is not publicized real well, but it's in there as additional benefit.
Yeah. And I think by building that loan loss reserve up, that's kept maybe the return a little tiny bit lower. Yeah. But at the end of the day, because it's a newer fund, once that fills up, once you filled up the loan loss reserve, doesn't that kick in a higher return later because you don't have to keep using or putting money into the loan loss?
Yeah, I mean, eventually it does, but it's always going to be slightly lower because of that reserve.
Yeah.
But the advantage of the fund is we're not meant to be the highest generating returns for a fund because we're not taking the risk.
Yeah.
You know, it's and you got to look at what's behind the portfolio and the assets that secure the portfolio, and we're trying to find investors who want a predictable, consistent, competitive return, not a return that goes up and then down and up, and consistent. Somebody can rely on the fund for either fixed income or compound for growth. That's sort of our goal.
That's great. And can you use like 401k or IRAs or anything like that, retirement funds to put into Fidelis?
Yeah, some of the benefits to our investors, one is you can invest in IRA, defined benefit plan, profit sharing plan. So we allow those type of investments through an LLC, corporation, trust, so an individual. So that we have some flexibility there. The minimum investment's $50,000, so it's not huge.
Right.
The maximum's $3 million. So we're looking for that smaller investor who wants to complement their investment portfolio with an investment in real estate, sort of a passive investment in Fidelis, and have it, it's a long-term perspective. It's not, we don't want an investor who just wants it as a holding account for 6 months
like
before
a checking account or something.
Yeah, before they want to buy another property next month or whatever. Sure. That's not the intent. The investor profile for us is long-term perspective, preserve their capital, want a consistent, predictable return for growth or just fixed income.
That's great. What would you say the profile of the typical investor is?
They're usually, they've done real estate development. They own a bunch of real estate. They're tired of managing properties. They're tired of the development headache, and they just want to collect income. Either
quarterly checks.
Quarterly checks, or let their investment grow. And they don't want any hassle, but they like the idea of being secured by real estate. They know real estate. And it's more of the younger real estate guys want to go out and be doing deals, and they need capital for their next deal. Where our typical investor for Fidelis is they've done all that, and they want to
chill.
They're maybe getting close to retirement or in retirement. They want fixed income, or they just don't want the hassle.
Talk about some deals that you look at. You probably see a lot of different deals on a day-to-day basis, right?
Yeah.
What do you turn away? What do you like? Like what kind of deals do you like?
Yeah, the typical deal that we look at are more added value deals, where the investor, where the borrower needs flexibility, creativity, and timing issues are involved. If somebody needs to close fast,
how fast do you think you can close?
We can close less than a week if we have the title report and all that information available. Yeah, so we can, the real estate's local where we know it. We need to be able to inspect the real estate. But yeah, we can close fast, and it's usually deals where the property's in transition, or they're adding units or adding value to it somehow, and they're getting it from point A to B, and then they either refinance or sell as the exit strategy.
Yeah, that's
the typical deal is just added value. And currently we're seeing, with this housing shortage, we're seeing a lot of ADUs, additional dwelling units, and that's been a big opportunity for us to help people capitalize on their property. People that own properties that aren't improved to the highest and best use, they come in and we could put in a few units here. And so they're coming to us for those type of loans because they don't want the headache of, going to a bank and all the bureaucracy that's involved.
Yeah. You just get it done quick, and you're in and out, and you got your money, and it's good. Not a lot of people can say and have a track record like you, where they can say, "Hey, I've never ever lost a cent for an investor, and I've managed over $100 million, in a fund, and through the crash, I went through the crash. I lost money. I had a little second mortgage fund that lost money, and that was a terrible time. Like through 08 and 09, and where like just the values just dumped and crashed, and but like the track record that you had through the crash. Tell us about how that happened, and like kind of how you didn't didn't lose any money. That's a pretty cool story.
I think, one, we had a loan loss reserve. So I learned that we did tap the loan loss reserve. So you're going to have issues in a fund. I mean, through hard times, you're going to have loans that maybe go bad, but it's how you manage those loans with the borrowers and the relationships that you have, and working with borrowers, modifying loans, and not, with a heavy hand coming in and foreclosing right away, because that may not be the best thing to do.
Sure. And
working with our borrowers, we had to foreclose on a few properties, and we tapped our reserve, but the deals that went bad or could have gone even worse, we modified them. And our returns went down to like 6.25%.
Wow.
But that's still
a return.
But because
versus losing it, right?
Oh yeah, versus losing it. So the worst of the worst, there's going to be issues, but I've been through the worst. I believe the worst, and these times we're going through now are near as what we were going through before.
Yeah, but I think back then, and correct me if I'm wrong, the business kind of dry. Did it dry up? Like, you weren't making new loans, were you in 08 or 09, or were you? Yeah, I mean it's interesting because values dropped 50% at that time, and that must have been hard to navigate.
Banks just were scared to death,
right?
And the best time to lend is in a down market.
Yeah.
Because you're lending on values that are low and your equity just grows over time. So we took it as an advantage in these properties that were selling for, these residential homes that were selling for $200,000.
Yeah.
We were making loans as fast as we could. And those were the best loans we ever made.
Oh, man.
And the people who stepped up had the equity to do it.
Yeah,
was the best investments they've ever made.
Absolutely.
So I think you just got to be wise in looking at the types of deal, and the borrower relationships is key, and knowing your relationship. And that I'm keying on relationships it's, a property can have a lot of equity, but if the relationship, I don't feel good about the relationships, I'm not going to do the deal.
Yeah, that's a good strategy.
Yeah.
Tell us more about your investment strategy.
I just think it's, again, going back to the relationship first, the real estate, where I know I can get out. Our loans are short-term bridge loans, so we're not looking to hold them long. So I need to know how am I going to get out of it. Yeah. And so I always look at the deal going into it. What's the exit strategy, and how, if it's a refinance, how is that going to be refinanced, and what the loan amount would be with the lender. And so I work backwards to figure out what my loan should be, so I know I can get out if it's either a sale. So the strategy I think is just finding loans with good borrowers that I trust, and I know I can get out at the exit strategy is clear and is understandable and achievable.
Yeah. So I've done quite a few private money loans in my day, and sometimes the borrower isn't ready to pay it off, in time, right? So it's like they're balloon loans. So do you have like a mechanism in there in Fidelis where you can, renew the loan for another year or 6 months? Or is it like you charge another point? Like, how does that, or 2 points? Like,
yeah, I mean, we have loans that we have to renew. There's no question. Things happen. Life happens.
You don't file an NOD like if they.
No, that's what I'm saying. There's no. I mean, we work with our borrowers, and they have to pay an extension fee, but I haven't had any issues. I mean, not that I'm going to have issues. You can't get away without having issues.
Sure.
But it's, just providing an adequate extension that, again, is looking at what's the exit, what are they trying to do, is it achievable, what they think they're going to do, and making sure that I match that extension with what the exit's going to be.
That's good. I think in your experience being in the business over 30 years, that helps to, your professionalism about knowing, right? Like in your the wisdom you've gained over the years is like, it's priceless in this type of business, because you can kind of see things pretty quickly versus like someone that's newer in the business may not know, like there's some pitfalls that might be out there, right? And lending on properties and things like that.
Yeah, it's like way back when, it's like put a lot of value in the appraisal.
Yeah.
Oh, there's a lot of equity there, and yeah, that's a tool to use for sure, but it's not the tool that drives the deal for me. It's how I feel about the borrower, how the appraisal comes into the equation, but and what the exit is, and who, what's their reputation, and how do they treat people out there? Because I don't
experience too, right? If the borrower has experience,
doing experience stuff. And just I want to work with people that I'm not going to have issues with. Yeah, and regardless of the equity, they could have a ton of equity in the deal, and we don't want to own property. That's not the intent of this fund. It's to get in and out and to provide a competitive, good return to our investors.
That's right. So just a minute ago, you mentioned something about the market and feeling a little bit like '08. In some ways, I've heard other mortgage brokers talk about, man, this is worse than '08. And I'm like, it's not really worse, but maybe your business is drying up and stuff like that. But like, where do you think the market's headed right now?
I think it's, I think everything's delayed, and I feel that
all the news is like news from like, we kind of knew what you were telling it. Like we felt it back then, but the news is kind of delayed.
Well, I just don't feel that the impact of the high rates have hit totally. So I think it's going to I don't think the rates are going to go down anytime soon. Do you think
you're going to plateau?
Yeah, I think they're going to plateau, and I think the economy may get the effects of this high rates are going to affect, I believe, the economy more and profits of companies, and I think you're going to see some
layoffs, and
I think you're going to see some more. Hopefully, we don't go into recession, but we may, because it's always a delayed reaction. They can't increase rates, like they have 5.25% in such a short time, and have things not happen. And I think, anyway, that's. But as far as back compared to '08, I mean, property values haven't dropped much. I think cap rates haven't really gone up much. So, the inventory's tight. There was back then there was so much supply.
Much supply.
And it's just a different market as far as supply and demand. So I think that in itself will keep prices fairly high, just the inventory.
Yeah. So, I mean, some of us remember high rates, like really high interest rates. First mortgages, I remember 10.25, but I was doing subprime. So 10.25 and 6 points. Some people I've heard, you were in the business before I was, so you probably remember even higher than that. Is that right? Like,
well, before I got into banking, just when I was in college, the rates were, in the teens.
Yeah. Like I think my parents' first house they ever bought was in like 13% or something like that. But
I don't see it going that high.
You don't think?
I think
that would like explode the country if that happened. Probably.
I don't see them going up much more. I mean, I think they're going to level out here and see how this affects these rates. I mean, it's back then they increased as fast back in the early 80s as they did now. And it really took a toll after the fact, and I think we haven't seen a little bit of that yet. So I think the economy might get a little worse because of the fast increase in rates.
Yeah. If the housing market were to decline, what would cause that? Because like I keep looking back to supply and demand, and that's a huge driver of the price of the values, right? And stability. But I still think like, is there something I'm missing? Like, is there something that could cause the values to drop that I'm just not seeing? Because, I've been through '08. I remember it was massive supply. That was huge. Mm-hmm. It was being underwater, right? And it was this whole chaos where that isn't what's happening now. We have high values. No one's underwater. We have historic equity in homes. So what do you think could cause any kind of drop?
I mean, you always could have the catastrophe of some sort.
Yeah.
Disaster, that could do something. But the banks since '08, they've underwritten loans well. So there's not a lot of bad loans on the books. Banks have good credit. There's not, like you said, the supply is low. I mean, I think unemployment's a key thing. I think I feel if there's a lot of unemployment, that could cause some problems. But I don't see that right off. So I really don't see we have a housing shortage. There's a lack of housing.
Yeah.
Huge number of units that need to be built every year, and they're not even meeting that.
Right.
So I just think we're in a good position, San Diego especially. There's other markets in the country that have been hit harder than us because, again, San Diego is geographically constrained.
True.
There's only, you can't go west, east, south, or north.
Yeah.
There's just, in Phoenix, you can go Austin, all these places you can go and go and go.
Right.
And I think that's one reason San Diego, I think, is going to remain, the values will stay up there.
Yeah, that's good. Do you know about any missed opportunities that in the mortgage industry, you think?
The added value deals that we're seeing, I mean, I think that those are the opportunities that I see. As far as missed opportunities, I think taking advantage of those.
Yeah.
And these banks, I got a call from a bank that just said, "Hey, we're not lending right now because we need
deposits."
They need reserves.
Yeah.
So again, that's their business model. They can't control the demand of deposits, withdrawals, and so they have to do that. But taking advantage of the lack of inventory and supplying credit for housing, I think that's an opportunity that we're taking advantage of. And if I had more funds to do that, I would, because there's such a need for it.
So you have more deals than you have the funds to
I mean, we just need more capital, and I think
that probably helps too with you can kind of cherry pick the best deals in a way and the best borrowers, right? Is that kind of helps, and it's a double-edged sword because it helps with the quality of the lending, but it also, you're like, God, I want to make more loans, right? It's like,
so our intent, I'm not trying to grow the fund just to grow the fund. I'm growing the fund to help our borrowers. Our mission is to help people, and I want to help our repeat clients, and I want to help them when they need the next deal. I want to be there for them, and that's the reason I want to take advantage of this opportunity.
And you work with mortgage brokers, right? Like a broker can bring a deal to you. And
we work with a lot of mortgage brokers. So, and we protect our brokers and make sure that we don't go around the broker. We're definitely an advocate of the broker.
That's good. So probably what percentage would you say deals are brought to you through broker channel?
25%. Yeah. I mean, I have such an extensive relationship database. I get a lot of referrals, just internal referrals. And we get so much demand locally that I get brokers outside the market calling me for deals in different states, but we're just don't have the capacity, and we really don't want to at this point. The local brokers I work with mainly.
So I know that Fidelis doesn't do a lot of seconds because it's just not really the model, but with the non-QM seconds, is that a good kind of piggyback onto what you're doing at all, or do you see any kind of synergy with non-QM and private money?
The non-QM market is a great source for us. So especially on single family properties, investment properties, where we get it to where it can be financed conventionally or through non-QM. And so, we use non-QM to some extent that fit. A lot of our loans don't fit the non-QM model, but the ones that do, we definitely do.
Yep. That's good. So how do you stay motivated about life and business? Sometimes you get there's bad news everywhere, right? Like, so how do you stay motivated?
I love challenges, and that's not only in business, personal challenges. I'm sort of, as far as running, I run a lot. Yeah. That keeps me, keeps me sane, and allows me to, gives me time out to, I love running out in nature, trail running. So I always get out often, and that helps me, reduce the stress and time to think. And, that's pretty, and then just health wise, I think as I'm getting older, that's all we have really. We have we have to keep care of ourselves so we can help other people. And
right.
So that's my focus is keeps me motivated to be healthy, and so I can be here and help other people.
That's good. Any shout outs to someone that's helped you along the way?
Yeah, I've got a lot of people that have helped me along the way.
I don't want to just say one, right?
Yeah. So I've got a lot of mentors throughout, in the banking industry. In fact, some of my few limited partners that I have in Fidelis they've known me for 35 plus years, and they were there when they helped me in the banking business when I first started. So yeah, and I'm just blessed to have good partners like Jon Maddux here and Chad Rule and Sam Atisha. Sam's a great benefit to the fund as well. He's a real estate investor, an entrepreneur. And so I think having it's not, Fidelis isn't about me. It's about my team and the management team that we have collectively, the experience we have. We can benefit a lot of investors through our experience. And that's one takeaway I want to leave is with our investors that the management of the fund is crucial to the success. And also these general partners that I've been talking about, we have a vested interest in the fund because we have our own money in the fund.
Right.
We have over 10% of the total capital of our own money in the fund. So we're
believers.
Yeah, we're believers. So, I think
we're lucky to be.
It's not just me out there trying to get capital. It's my own money. Yeah. It's my future. I'm managing. And so I want to make sure that I have it and it's there. And so that's a key benefit.
That's great. Yeah. I believe in you, Jon. It's been a good run so far. And I mean, even when things get kind of crazy in the market, it's like, I just see, you're always in that office just on the phone, and you have business rolling in, and obviously the referrals speaks volumes of what you've done over the years. So I think that's amazing, and just being able to see that return every quarter, just inch up. Obviously, everyone wants higher and higher returns, but not at the sacrifice of security or having a good solid fund. So I'm a huge believer, and that's why I got my money in it. So. Yeah. Any other additional benefits from the fund?
Yeah, I mean, you've got that minimum investment of $50,000, which is allows people to get in. And again, it's accredited investors. You have to have $1 million net worth outside your house as accredited investor. But just being able to get in at $50,000, and there's a 1-year commitment. You can't. This isn't meant again to a short-term. Checking account, high interest checking account is meant more of a longer term investment. And then just having the money always reinvested. A lot of investors in trust deeds, they'll invest in a trust deed and it'll pay off, they'll get their money back, and then they got to find another one.
Right.
It may be double digit returns, but by the time they get it in and out, their returns.
You don't think about that, right?
Yeah. So I was getting
put your money back in your checking account, and then that's giving you nothing. And so then, you got to wait another 3 months to find another deal. Then you lost 3 months of that return. So it averages out, way lower than you think.
Yeah. So I think just being reinvested all the time, that's our responsibility. You don't have to worry about that. So that's a benefit. And just the diversification of the number of loans and the product type. We, do multifamily, single family, some commercial, retail, office, industrial. So it's a variety of product types. So it's well diversified. And it's, again, in the end, just to hit that you can invest your IRA money. Yeah. Again, is an advantage. Take advantage of that. And
it's a good tax benefit for sure.
So I think and it's also, again, the acceptable liquidity. It's a short-term fund, and the loans are short-term. So they roll over the average loan rolls over less than a year. So, it's acceptable liquidity from an investor standpoint.
That's good. And a lot of your investors are also customers, right? They borrow too. So like you might have someone that is a borrower, but is also an investor.
Yes. Yeah. I have several that are both.
Yeah.
So you can invest your money in the fund and also be a borrower too. So
that's cool. So if a broker wants to reach you to either put money in or to just do a deal, like how do they reach out?
Yeah, our website, fidelispf.com, is probably the best place, the most resources. You can always call me on my cell phone, 702-379-3468.
Cool.
And just talk to John or Chad, and they can get me. So we have a great team, Fidelis, that is here to help.
It's awesome. Cool. Well, thanks everyone for listening, and thanks for coming on the show, John.
Yeah, thanks for having me.
All right. See you on the next podcast.
The $1 Million Mortgage Experience Podcast.